Hello everyone, welcome to the class of Financial Institutions and Capital Markets. Today let's continue with Chapter 8, Stock Market, and hopefully we'll finish the rest of the Chapter 8. So this hopefully will be the last class for this chapter and also for our class this semester. So in the previous class of Chapter 8, we have discussed common stock. Today, let's continue with preferred stock. Preferred stock is a hybrid security that has characteristics of both bonds and common stock. So similar to common stock in that it represents an ownership interest in the issuing firm, but like a bond, it pays a fixed periodic or dividend payment. So that's why it is called a preferred stock. So it does represent an ownership, but also it kind of gives you a guarantee or more security in terms of how much you would get as a return from investing in the firm. So preferred stockholders generally do not have voting rights in the firm. So to be fair, yes, you do get as we mentioned before, like securities in terms of your rate of return, but at the same time you have to give up on your voting rights. But most stock may be converted to common stock at any time the investor chooses. So yes, right now when you hold the preferred stock, you don't have voting rights. But if you want, you can convert it to common stock and then you will be able to have voting rights. So it's all up to you. Dividends are generally fixed or paid quarterly and are expressed either as a dollar amount or a percentage of the face or par value of the preferred stock. So suppose you own a preferred stock that promises to pay an annual dividend of 5% of the par or face value of the stock, received in quarterly installments. If the par value of the stock is $100, what is your annual dividend? This one is kind of too easy, so I even never put the answer. It's just $100 times 5%, right? So it's going to be $5. To summarize, the advantages of preferred stock is that they are unlike coupon interest on bonds. Dividend on preferred stocks can be missed without fear of bankruptcy proceeding. So that's the advantage for the company, right? And also it is beneficial to the issuing company's debt holders as they are paid by the generated income first. So preferred stock, although it has the priority, but it's only the priority compared to the common stock, not compared to the debt. So debt holders still have the priority over preferred stockholders. So the drawback is that it has a strong signaling effect. Preferred stockholders must be paid on time at the rate of return consistent with the risk associated with preferred stock. Otherwise, new investors will be reluctant. So it's kind of the company has made its promise. They have to keep their promise. Otherwise, it will send out a bad signal that the company is doing badly. So that will deter new investors, right? And also the drawbacks is the second drawback is doesn't have tax benefit because it's stock, right? So it's not like debt. It has the tax shield. That has the tax shield. But that part is okay. You can just have a look at it. This part that I highlighted, it is important. You need to know what is non-participating and participating. Also what is cumulative and non-cumulative. So typically preferred stock is non-participating and cumulative. Non-participating preferred stock means the dividend is fixed regardless of any increase or decrease in the issuing firm's profits, while participating preferred stock means actual dividends paid in any year may be greater than promised dividends. So participating or non-participating means whether the preferred stock, the return on the dividend paid on the preferred stock is linked with the firm's profit every year or not. And cumulative preferred stock means that any missed dividend payments go into arrears and must be made up before any common stock dividends can be paid, while dividends of non-cumulative preferred stocks do not go into arrears and are never paid. Yeah, so that's the difference between cumulative and non-cumulative. If it's cumulative, means that you must pay those preferred stock first before you pay dividends to the common stocks. If it's non-cumulative, then if it's missed, then it's missed. That's the two difference. So these two, you have to know. These two categorization, you have to kind of know the difference between them. This part you can just have a look at it, not very important, so we'll go through it quickly. That's for primary stock markets. They are markets in which corporations raise funds through new issues of stocks, and most primary market transactions go through investment banks. Investment bank can conduct a primary sale using either a firm commitment or best efforts underwriting basis. So this is actually what we discussed before, right? For the bond issue, it's the same thing. Issuing. In firm commitment or underwriting, the investment bank guarantees the corporation a price of newly issued securities, while best efforts underwriting occurs when the underwriter doesn't guarantee a price to the issuer. A syndicate, well, this part is not important, but you can just know it like as a common sense. What is a syndicate? It is a group of investment banks working in concert to sell and distribute a new issue. The lead banks in the syndicate is the originating house. So this is how it works. Between investors and the issuing company, there's investment bank that basically handles or manages the whole issuing process. This continue discusses primary stock market, and it is important to emphasize that primary stock markets includes two parts. One is the IPO, which is the initial public offering. That's the first public issue of a financial instrument by the firm, and also the seasoned offering. So this is after the IPO. All the other sale of additional securities by the firm whose securities are already currently publicly traded is called seasoned offering. And notice that primary market sales include both IPOs and seasoned offerings. And in both cases, the issuer receives the proceeds of the sale and the primary market investors receive the securities. Yeah, so they are always like this process shown in this graph. This part is important. It's called preemptive rights. So that is for the existing shareholders. So these preemptive rights give existing stockholders the ability to maintain their proportional ownership by purchasing shares at a price slightly below the market share. What does it mean? It means that, let's say, right now the company worth $1,000. I am the biggest shareholder. I own $500, so 50% of the share of the company. If the company decides to issue new shares, let's say issue another $1,000 in the stock market, right now I only own $500 worth of share. But if the company, after the company issues another $1,000 new shares, then I will be only holding the company, like how much, 500 divided by 2,000, that will be 25%. So my part of the share will reduce from 50% to 25%. That's not what I want, right? Before, I'm almost a controlling shareholder by owning like half of the company. Now I'm owning 25%. So if another shareholder holds larger share than I have, then he's going to have more saying in the company's management than I do. So to protect my share as an existing shareholder, whenever there's seasoned offering, I'll be given these preemptive rights to help me maintain my proportional ownership by purchasing the shares at a price slightly below the market price. So stockholders can then exercise their rights by buying the allocated shares in the new stock or sell them. If they don't want to buy, they feel, I don't have extra money, I don't want to increase my share. I don't want to increase my investment in the company. Then they can sell these preemptive rights. So now the key is how to price these preemptive rights. What is the right value for these rights? So here's an example for it, for you to show you how to calculate this, how to price this preemptive rights. Suppose you own 1,000 shares of common stock in a firm with 1 million total shares outstanding. The firm announces its plan to sell an additional 500,000 shares through a rights offering. Thus, each shareholder will be sent half, so 0.5 right for each share of the stock owned. Why is it 0.5? It's because right now the firm has 1 million shares outstanding, and they're going to issue new additional 500,000 shares. So that means the new issue is going to be half of the outstanding shares, right? That's why each shareholder will be given half right, so that they can maintain their current ownership. So your current ownership interest is 0.1%, which equals to 1,000 shares that you own right now divided by 1 million shares outstanding. Prior to the rights offering, and you receive 500 rights, which equals to 1,000 times 0.5, allowing you to purchase 500 of the new shares. Suppose the market value of the common stock is $40 before the rights offering, and 500,000 new shares are offered to current stockholders at a 10% discount, or for a $36 per share. Yeah, so these are the conditions you need. The questions are, what is the value of one preemptive right if you decide to sell them? So how should you price it? And second question is, does your total wealth change if you decide to sell your rights to other investors rather than exercising your preemptive rights yourself? Yeah, does it change your total wealth, whichever position you decide to take? So these are the questions. Let's see how to solve this question. Right now, the market value for the firm after the rights offering should be $58 million. Why is it 58? Remember, the price before the rights offering was $40, right? So that's original $40 million, 40 million. So that's $40 times the 1 million shares outstanding plus the 18 million from the new shares. Why is it 18 million? Let's assume all the existing shareholders will buy the new shares, new issues. Then they will pay $36 per share, and then a new issue is 500,000 shares, right? So that's in total $18 million. So that's the that's the current market value of the firm, or $38.67 per share. Why is it this price? Where does this one come from? This is actually the key. We really need this price. This equals to $58 million divided by 1.5 million shares outstanding. So right now we have 1 million shares plus the 500,000 new shares issued in the new rights offering, right? So in total we have 1.5 million shares outstanding after the rights offering. And the current market value of the firm after the rights offering is 58 million. So therefore we use the total market value divided by the total shares outstanding. So that equals to $38.67 per share. Your your 1,000 shares were worth $40,000 at that time before the rights offering, right? So because the price before the rights offering was $40, but the price will change after the rights offering and will change to $38.67, $38.67. So, and you can purchase 500 additional shares for $18,000. That's $36 times 500. So therefore, your total investment in the firm after the rights offering would be $58,000 if you decide to buy purchase these 500 additional shares, or 38.67 per share. So that's $58,000 divided by 1,500 shares that you own. Yeah, so this is one way to calculate it too. You can either consider the firm as a whole and using the total market value divided by the total shares outstanding after the rights offering, or you can just consider yourself. So add up all your investment in the firm divided by all the total number of shares you own. So either way, you can get this new price, 38.67. Suppose you decide not to exercise your preemptive right, since each right allows a stockholder to buy a new share of $36 per share when the share was worth 38.67. The value of one right should be the difference between these two, so that's $2.67. $2.67. That's how you price this preemptive share. So the difference between the price offered to the existing shareholder and the market price after the rights offering. And how to calculate the market price, this is the key, because this one is already given by the question, right? So this is the key. And how to calculate this one? I've shown you two ways to calculate it. Either you consider the company as a whole and using the total market value divided by the total shares outstanding. And remember that the total market value is the new market value. That equals to the old stock price times the old the original shares outstanding plus the new price offered to the existing shareholder times the additional shares issued in the new rights offering. Yeah, so that's how you calculate the market value, and then divide it by the total shares outstanding after the rights offering. You'll get the new price, and the difference between the new price and the exercise price offered to the existing shareholder is the price of the preemptive rights. Sorry. So you could also sell. So this answers the first question, right? What's the value of one preemptive share if you decide to sell them? Then let's come to the second question. Does your total wealth change if you decide to sell rather than exercising the preemptive rights yourself? So if you decide to sell your shares, then your preemptive rights, each one worth 2.67 cents, right? So, and then you have 500 shares. Therefore, you can sell your rights to other investors for $1,333 plus the value after the rights offering. Yeah, so you initially have 1,000 shares, and now the current market price is 38.67. So now your value is going to be $38,667. Yeah, so you add these two together, you have 40,000. That's your total wealth, which is the same as your original shares, right? The original value of your total investment, which is the original price $40 times 1,000 shares. So you have lost no wealth. You have no loss in your wealth, right? So this is the preemptive rights, and you see I've highlighted many parts, which means this part is important. You need to know how to calculate it. Okay, so this part is not very important. We can actually skip it. It's about the registration of the stock on the primary stock market. There are two ways. One is the red herring prospectus, and this is actually no matter which way you do, you have to go through this part. So this is a preliminary version of the prospectus that describes a new security issue, and firms use the feedback provided from the distribution of the red herring prospectus to help set the price on the new shares to ensure the sale of a full issue. Yeah, and then after that, it's shelf registration allows firms that plan to offer multiple issues of a stock over a 2-year period submit one registration statement. And then they can use this one registration statement to do multiple issues over a 2-year period. So that's called shelf registration. And then this one is an explanation of the red herring prospectus. So from the firm, once the firm decide to issue new shares, they can prepare. And they prepare all the documents and submit the registration statement to SEC. Once they submit, SEC have up to 20 days to send back their comments. So SEC will request changes or additional information to the registration statement. And within this period, it's red herrings prospectus sent to prospective buyers. Yeah, and then after that, the firms will have to make changes as requested by the SEC or submit new, additional information. And this could take few days up to several months, depending on how much material or information they need to prepare. Then that will be the official prospectus issued, and then within 1 day the shares will be offered to public. But this part is not important. You don't have to remember this part. And this is about the shelf registration. So it's like a 2-year window. And once they submit the registration to the SEC, they can do multiple issues. So this is one issue. You see, from decide to issue to shares offered to the public, it only takes 1 to 2 days. And then if they want to do another issue within this 2-year period, they can just do it very easily, like within 2 days, right? So this is shelf registration. Here is an exercise question. Which of the following the firm pre-registers with the SEC any securities it wishes to sell over the next 2 years? So that's clearly shelf registration, right? So that's the one that we just discussed. So D is the correct answer. And then now let's discuss the secondary stock market, where we discuss stock exchanges. That's where investors trade, right? So secondary stock markets are the markets in which stocks, once issued, are traded by the investors. In secondary market transactions, funds are exchanged, usually with the help of a security broker or firm acting as an intermediary between the buyer and seller of the stock. So original issue of the stock, which is the company, is no longer involved in this transfer of stock or funds. And there are 2 major US stock markets currently. One is the New York Stock Exchange, Euronext, after they merged. So that's their full name. And then the other one is NASDAQ. The full name is National Association of Securities Dealers Automated Quotation System. Worldwide, the New York Stock Exchange Euronext is the most well-known of all the organized exchanges. It's also the biggest, especially after the merger of the New York Stock Exchange Group and the Euronext on April 4th, 2007. But this one, you can just have a look at it. It's not very important. This one is program trading, especially about the price band, the limit up, limit down rules. But this one, I assume most people know it. It's just like common sense that if the individual stock experience big ups and downs within a day, they can kind of stop the trading of the stock for a while, depending on how big is the volatility. And if it's too much, like the whole S&P is experiencing 20% decline, regardless of the time, the market will closes for the remainder of the trading day. So this is the circuit breaker levels, the limit up, limit down structure in place in 2016. But it's not very important, so I won't go into details. You can just know it roughly. Every country has their own policy or rules about the policy, the price band. So I'll skip this part. This is about stock code. I highlighted it because I think it is important for you to know. Also as a common sense, because you may at one point in your life you may want to begin investing stocks. So it's better to at least know a bit about how to read the stock code now from the class if you can. So for example, this one, the name is called Abbott Laboratories. This is its symbol, and the closing price is $53.75. Didn't say which date, but let's just assume it's like, let's say, closing today. The volume is 4.9 million. Dividend is $1.3. The latest one, I guess, PE ratio is 44. That's price divided by earnings per share. And year-to-date percentage change is 10% increase since the beginning of the year. So in this code, there are 4 questions we need to answer. First, what was the dividend yield? The dividend is $1.3, right? And the stock price, the one that we know right now, the only price we know is $53.75. In this case, the dividend yield will be just using this dividend divided by the price. That will be the dividend yield. And the second question is, what were the earnings per share for the most recent 4 quarters? Earnings per share is EPS, right? So the latest PE ratio is $44 based on this price. Therefore, we can use this price and the PE ratio to calculate earnings per share. PE ratio is price divided by EPS equal to 44. Therefore, we can use this price divided by the PE ratio, then we can get the EPS, right? So price divided by the 44, then we can get EPS equal to $1.22. That's the EPS. And dividend yield is just using the dividend divided by the price, then we get 2.4%. The third question is, valued at the closing price, what was the total dollar volume of shares traded? Yeah, so this is the closing price, and it's asking what was the total dollar value of shares traded. This is the number of shares. This is the price, so it's actually very straightforward. Just using this price times the number of shares outstanding, then we get the total dollar value. Right, so this $53.75 times this 4.9 million, then we get this is the value of the company at the close. Sorry. And then the last question is asking what was the stock price at the beginning of the year. Then we will need to use this one. This is year-to-date percentage change. Means that this price. So until today, the price has increased 10.3%, and this is the closing price today. Therefore, we can calculate the stock price in the beginning of the year using these 2 amounts. So that's the stock price at the beginning of the year. Yeah, so let's assume the beginning of the year the price is P begin. Then we should have this relationship, and then therefore we can calculate the price should be equal to $48.73 compared to the current closing price $53.75. This one has increased 10.3% till today. Yeah, so that's how to rate a stock code. And then this one discusses the Nasdaq and the OTC market. We actually discussed this one before. The Nasdaq actually was the world's first electronic stock market. I think it's in the other course, Introduction to Finance, we also discussed how Nasdaq works in detail, right? It's a dealer's market. Compared to the New York Stock Exchange, it's the negotiated market. So you have dealers who make the market, right? They stand ready to buy and sell particular securities and make the market. So the one thing that I want you to know about the stock exchange is this one. The reasons of a Nasdaq stock exchange listing is attractive to a firm. Well, for firms to be listed in New York Stock Exchange, they must meet the listing requirement of the stock exchange and can be extensive. So not all firms meet those requirements, but they still want to be listed there. There are mainly 3 reasons. First is improved marketability of the firm stock. Yeah, so once you list it there, they basically you face more investors. You're going to have more demand. You expose yourself more. So also the increase the publicability of the firm and improve access to the financial markets. So all this will, the improved marketability actually will also help improve the company's stock price, because there will be more investors being able to see you. So therefore, increase your demand and help increase your price. And firms do not meet the requirement of the New York Stock Exchange listings will be traded on the Nasdaq. So most of the Nasdaq firms are actually smaller, of regional interest, and are able to meet the listing requirement of the organized exchanges. But some firms actually started from Nasdaq and then they remained there even after they could meet the requirement of New York Stock Exchange and never left. So the gap between these two actually are narrowing these days. So here's an exercise question. New York Stock Exchange listing has traditionally benefited the firm by A. improving the stock's price, B. generating increased publicability of the firm, C. providing easier access to primary market capital, D. generating increased publicability of the firm and providing easier access to primary market capital. E is like everything we mentioned, improving the stock's price, generating increased publicability, and providing easier access to the primary market capital. So the correct answer for sure is E, right? Because we just listed here. There are 3 reasons. So all these 3 are the benefit a firm could gain by listing themselves in New York Stock Exchange. So that's this exercise question. Electronic communications, networks, and online trading, I'll skip this part. It's not very important and kind of too detailed. So this part kind of have to know it. Stock market indexes. This one we hear it all the time, right? A stock market indexes is the composite value of a group of secondary market traded stocks. The one that we often hear is this Dow Jones Industrial Average is the most widely reported stock market index and includes the value of 30 large corporations selected by the editors of the Wall Street Journal. Yeah, so it's the 30 large corporations, but it's manually selected by the editors of the Wall Street Journal. And Dow Jones indexes are price-weighted averages, so they use the price as the weight. And the New York Stock Exchange Composite Index includes all New York Stock Exchange listed common stocks. And this one's value-weighted index means that for those companies whose has bigger value will be weighted more than those small companies. While Dow Jones indexes, because they are already pre-selected, they're only 30 large corporations. So in this case, they are not really they're not weighted by their value, but instead they're weighted by their price. And then we also have S&P 500 index. This one is also widely used. It consists of stocks of top 500 of the largest U.S. corporations listed on the New York Stock Exchange and the Nasdaq. So this one has clearly much larger pool, right? It has 500 stocks. And then we also have the Nasdaq Composite Index, consists of stocks traded through the Nasdaq that are industrial, banks, and insurance companies. Yeah, so to be listed in those indexes, they have to meet certain criteria. And like Dow Jones, even after there's even no specific criteria because they are selected by the editors. So, and others, there are some strict criteria you have to meet. And after that, you automatically been selected into the index. So that's why different indexes have different movement. Yeah. And they also have different policies, like whether it's value weighted or price weighted. Yeah, so here's an exercise question. It says stock splits change the divisor in a price weighted index, but do not result in any net change in the divisor of a value weighted index. True or false? Yeah, it's about stock splits. What does it mean? It means that right now, let's say Apple. I don't know what's the price of Apple stock right now, but let's just assume it's $100 per share. I want to do a stock split. Let's say one share splits into 2 shares. Then that means if the price right now is $100 for Apple, then the new after the split is going to be $50 for Apple, because one share now becomes 2 shares. So the value of the company doesn't change, but we expand the number of shares. We double the number of shares. That's stock split. Why would people do that? Simply make the price of the stock more affordable, right? So cut it into half, make it more affordable, make it like increase its liquidity. That's basically the main purpose of it. So after stock split, the price will reduce, right? So that means it will change the divisor in the price-weighted index, because the price is going to change. But it doesn't change the value of the company, because the value remains the same, right? It's only the price that changes. Therefore, it won't result in any net change in the divisor of the value-weighted index. So this one is true. Yeah, the correct answer is true. The next part is market participants, including like households, mutual funds, like financial institutions, etc. But I'll skip this part. If you want, you can have a look at it yourself. It changes over years though. Then other issues about stock market. So many times it can be used as the economic indicators to forecast future economic activity. We all know this part, so I will skip this as well. Okay, so this is the last part that I want to emphasize. You see, I've highlighted this part is the market efficiency. What does market efficiency mean? It refers to the speed with which financial security prices reflect unexpected news. Yeah, there are 3 types of market efficiency. The first one is weak form market efficiency. This concludes that investors cannot make more than the fair or required return using information based on historical price movement. Yeah, and empirical research has suggested that most of the markets all over the world are weak form efficient. Means that investors basically they can't make abnormal returns based on the historic price, the historical information. Yeah. And the second one, semi-strong form market efficiency, which means that investors cannot make more than the fair return by trading on public news releases. So that's semi-strong. That means financial markets have generally been found to immediately reflect information from news announcement. Yeah. And the last form is strong form market efficiency, states that stock prices fully reflect all information about the firm, both public and private. So that implies there is no set of information that allows investors to make more than the fair or required rate of return on the stock. Here is an exercise question that could help you better understand the market efficiency. So it asks, what are weak form, semi-strong form, and strong form efficiency? Does one form of efficiency imply another? So to answer this question, it's actually what we just discussed in the previous slide. Weak form efficiency implies that past price and trading information is contained in today's stock price and is of no value to an investor, which means an investor cannot use past information or historical information to get abnormal return. So semi-strong form efficiency implies that an investor cannot use any publicly available information to predict tomorrow's price change. And strong form efficiency implies that public and inside information is of no value in predicting tomorrow's price change. So you see the difference in these 3 forms of market efficiency lies in the different types of information. For weak form efficiency means that historical information is of no value, or basically, yeah, historical information is of no value. You can't use that one to predict to get an abnormal return. Semi-strong form means that publicly available information, even if it's like current like information right now, publicly available information wouldn't help investors to get an abnormal return. While strong form efficiency means that even if it's inside information, it's still of no value. Yeah, so that's the difference between these three types of forms of market efficiency. So if a question asks you to tell which form of efficiency is that, you just need to pay attention to what type of information is that. And strong form efficiency implies that the market are also weak and semi-strong form efficient, right? So if basically all public and inside information is of no value, that means historical information of course won't be any useful, right? Because they are already public information. And also even the current publicly available information also wouldn't be useful. So strong form information implies that the market must be also weak and semi-strong form efficient. Likewise, semi-strong form efficiency implies that the market are also weak form efficient. Yeah, so that's the relationship between these three types of market efficiency. Here's another exercise. Suppose that over the last 10 to 15 years, significantly large numbers of investors have been able to earn abnormal returns from using the firm's publicly available financial information. So you see, publicly available financial information means that this is semi-strong, right? But it says they are able to earn abnormal returns. So it means that it's not semi-strong. Then it must be the one that is worse than this. So which means it should be weak form efficient. So this would be an evidence that the market are not weak form efficient, semi-strong form efficient, and strong form efficient. If the market is weak form efficient, that means they are not semi-strong form efficient and strong form efficient. So the answer should be D, 2 and 3 only. Yeah. So the key here is first you see it's publicly available information. That means this is above semi-strong. But here it says they are able to make abnormal returns. If they are not able to make abnormal returns, then the market is semi-strong form efficient. Then that means the market is not strong form efficient, right? But since they are able to make abnormal returns based on publicly available information, then that means the market definitely is not semi-strong form. If it's not semi-strong form, then it's also not strong form efficient. So the only the market can only be weak form efficient. Yeah, but the question is asking the markets are not, therefore the answer should be D. Yeah. Okay, the rest are some other issues pertaining to the stock market, like regulations, international aspects of the stock market. They are not very important, so I skip this part, but you can have a look at it yourself if you're interested. Yeah, so basically that's the end of this chapter. Thank you all for attending today's class.